Now, 5 minutes to that. Shibani Sircar, Kurian is Senior EVP and Head of Equity Research at Kotak Mahindra Asset Management Company. She's with us to take some questions. Shibani, good afternoon. Prashant here. Let's just not talk about Adani to begin with. We'll get to that maybe a little later. Let's talk about the market per se. Do you believe that we are, especially in the consumption side, things have, because we've got new data, especially for, how the first 10 days, 15 days, etc. of November have panned out, which doesn't seem like it's been all that bad. Basically, the second half of the festive season doesn't seem to be all that bad. Everybody looked at some, consumer staple results, etc. from second quarter and panicked a little bit that maybe consumption is coming off sharply. But since then, you've got, fuel sales data, you've got recently air passenger traffic growth data, which is, for one day hit, a humongous mark, the highest ever mark, and a few other things as well. What's your sense, Shibani?
So, hi, Prashant. Always good to be on your show. So, yes, consumer and the consumption data over the last maybe more than a quarter or so has been a mixed bag. As you rightly pointed out, the beginning of the festive season data was fairly muted, and then it picked up in the second half of the season. We started seeing data, especially in terms of two-wheeler sales, passenger vehicle sales, even some of the retail data, which seemed to suggest that the second half of the festive season was possibly better than the first half was. However, when you look at the consumer pack as a whole, there were two key divergent trends. One is that rural, which was lagging over the last few years, now seems to be seeing some signs of improvement. However, the improvement in the rural demand is a gradual improvement and not a very sharp recovery. On the other hand, if you look at anecdotal evidence, including the commentary that you've seen from some of the companies that have reported numbers, urban consumption, which was holding up fairly well, has started to see some slowdown, possibly some rub-off effect in terms of slowdown, in terms of credit, especially unsecured personal loan, credit card growth going into that segment. So that's something that we'll have to wait and watch out for. So the overall trends on the consumer side have been fairly mixed. Now we are in the midst of the wedding season. We'll have to see how this trend really pans out over the next few months and whether this improvement that you're seeing on the rural side also continues. Our belief is that at this point in time, rural appears to be better placed, and therefore segments which benefit from rural recovery should also be better placed within the consumer basket.
Yeah, I was actually looking at a report from ICRA, their business momentum index, which includes a lot of high-frequency numbers like auto sales, for instance. That has shown a 10% increase month on month, which is better than the same period last year. So October is good. They're saying November is actually even better, going by the early Vahan data. So let's see. Hopefully it'll play out that way. Shibani, great to have you on the show. But, it's been a roller coaster ride for the market, right? Out of nowhere, we are dealing with this incessant FPI selling. Have you made any tweaks to the overall sort of portfolios, any profit taking on some of your earlier sort of investments on the capex side, on things like infrastructure? Any changes over the last 4 or 5 weeks?
Yes, so absolutely, Surabhi. So, we keep evaluating our portfolios, looking at valuations, looking at incremental earnings growth trajectory, etc. So when you look at the markets, clearly the markets have been impacted by both external and internal factors. And within the internal space, last 2 quarters of earnings have been muted, and that's possibly also weighing on the markets. So the way we are looking at our portfolio is threefold. We are looking at quality over momentum. We are looking at companies where valuations are reasonable and attractive as compared to pockets where valuations are excessive. And we are also looking at companies where liquidity and free float is high. So these are the 3 key areas that we're looking at. Having said that, when you look at the headline market and the correction that we have seen, if you look at a stock level, the correction on a broader basis has possibly been even higher than what the headline suggests. So in that sort of a market, we are looking at bottom-up opportunities. From a sector perspective, we have taken off some profits in segments such as industrials, capital goods, and even automobiles over the last maybe quarter or so. And incrementally, if you look at our positioning in sectors, we have an overweight stance on technology. We also believe that the larger banks, specifically the larger private banks, are well placed in terms of valuation, and risk reward seems to be favorable. And therefore, these are some of the segments that we are evaluating. Even in the auto space, we will possibly look at more the rural as compared to urban, and therefore two-wheelers over passenger vehicles. And therefore, these are some of the sectoral calls that we have taken in the last quarter or so.
Hi Shibani, good afternoon. Good to see you in. What about defense? We have chatted about this the last couple of conversations as well. And you're on board that the opportunity is great. Now these stocks have corrected from the top, both defense as well as railways. After this correction, do you think some of these stocks have come to levels that you would like to dip into?
So absolutely, Nigel. We have discussed this many a times in the past as well, where defense as an opportunity remains fairly large, both from a domestic opportunity as well as an export opportunity. So therefore, the structural thesis on the sector does not go away. The stocks have corrected, but remember also the valuations were fairly elevated given the kind of sharp up move that we have seen in the sector over the last year and a half. And therefore, we are keeping a close watch on it. Possibly we will, evaluate each of these companies on a bottom-up basis. The ordering that was gaining momentum over the last year or so has seen some degree of slowdown, and therefore the expectation is that maybe towards the second half, now the ordering should also start to pick up. In many cases, the order book itself is fairly large, and that should give some runway for growth. However, our overall evaluation within the defense space still remains very stock specific. And we do believe that while valuations have corrected, they still remain somewhat elevated, and therefore we will wait and watch.
Okay, all right. Just going back to the overweight stance on IT, Shibani, is that a play on the currency given the weakness in the rupee, or are you actually expecting better business momentum once the political environment clears up in the US with the elections behind us now?
So Surabhi, for us, IT as a sector has always been a play on business momentum. Our belief is that, even while currency may depreciate, if you look at over the last decade or so, currency has been depreciating, but margins have also come off in the sector. And therefore, the sector is very, very closely related to top line growth and revenue momentum. Now, for IT, there are a couple of things to look out for. Of course, we'll have to wait and see with the new president in the US coming in, what are some of the regulations and changes that they make, especially in terms of what they were talking about in terms of the corporate tax cuts, if that comes through. We'll also have to see what policies they adopt in terms of immigration, etc. However, what we are also seeing in IT is that after almost 2 years of low growth or companies deferring their spends on discretionary tech, a lot of that possibly is starting to come through, though it's still a trickle, and that's something that we will wait and watch for. And therefore, if that comes through, the revenue growth momentum is likely to improve going into next year. What we also believe is that, if you look at the sector per se, the structural opportunity in the sector remains fairly well intact. And it's a combination of both structural as well as near-term tactical play in terms of revenue growth momentum coming back, which has led to our overweight stance where IT is concerned.
Shibani, wanted to get to the piece on UPL, but how are you all placed on chemicals, specialty chemicals as well? There's a mixed feedback that we're getting, that things are not yet on the mend, while various companies suggest that from Q4 onwards, heading into FY26, they are hopeful that actually things will improve substantially.
So I don't know whether things will improve substantially, but this is a sector that has gone through a huge amount of headwind, both in terms of demand as well as pricing, with China clearly, coming into the fray. Now, it is possible that some amount of the impact that we have seen because of China dumping will possibly start to bottom out. However, the demand trajectory, especially where Europe is concerned, still does not give us confidence to see that there is a sharp recovery that is likely to be underway. Now, within the specialty chemical space, many of the companies have done capex, they have invested, and therefore they are well placed to benefit as and when the demand recovery happens. However, we will believe that it is still a few quarters away. The sector has seen sharp correction, and therefore stocks have come off considerably in terms of valuation. But whether the imminent recovery is likely in the next 1 quarter is difficult to say. It is possibly close to bottoming out, but will maybe take 1 or 2 quarters more for the recovery to play out.
Okay, all right, Shibani, we'll leave it there. Thank you very much for joining us. Appreciate it. And it's always good speaking with you here on CNBC TV18. The JSW Group is targeting an IPO for its cement division by January 2025. That's the word coming in from the group chairman, Sajan Jindal, in an exclusive conversation with my colleague Ritu Singh from the